So hello everyone. In this video, I'm going to go over how to answer various questions about financial policy changes and financial statement analysis. And I'm going to go through the questions about this. So with that in mind, let's start on these questions. So the first question we need to deal with is you're basically given a situation where there's this one accountant who is basically given various situations that might arise. So the chief accountant of this company has made several proposals about what could be done in terms of accounting policies. The company's chief managing officer wants the implications of those policies to be explained. Here there are several policies. So we have 10 policies overall, and you're being asked to explain the impact of these policies on various accounts, so net profit, total assets, etc., etc. So let's go through what the implication of these might be. All right, so the first one here basically says the policy change would be using a reducing balance instead of a straight line depreciation approach here. Now, when you've got depreciation here, under a straight line depreciation approach, you have a constant level of depreciation, i.e. it is the same amount of depreciation every year. However, under a reducing balance approach, it is going to reduce over time. There'll be a lot of depreciation upfront, and then it's going to get lower over time. Now we can think about this graphically as well. So say we were to just draw a basic graph here, what it might look like is we have in the vertical axis the depreciation per year, and the horizontal axis we can have time. And what we can look at is how the two depreciation policies might compare to one another. So let's first focus on straight line. So under straight line depreciation, you'll have the exact same amount of depreciation every single year. However, under the declining balance type of depreciation, it will start off very high, but then it will ultimately end up being lower. It kind of looks like the upper quadrant of, say, a hyperbolic function. In any case, when you do this reducing balance depreciation, you get more depreciation to begin with and less at the end. So at this point, what we're being asked is what is the impact of making this change on the current year's accounts? And we'd be changing from reducing balance or using reducing balance rather than straight line. So unsurprisingly, because we would have here more depreciation expense, we're going to reduce our net profit. So that's going to ultimately result in net profit being lower because our expenses would have gone up. Now that's not to say there's a problem necessarily. This is going to be non-cash net profit. The cash flows, however, could ultimately go up because the firm's tax payable could potentially go down. But that's another issue entirely. Just looking at a net profit here, it's going to decrease because our expenses would have increased. Okay, so in the next policy, you're being asked what would happen if you used weighted average instead of FIFO when prices have been falling. So to be absolutely clear here, we would be shifting to weighted average from FIFO when prices have been falling. Now, those are all things you need to bear in mind. When you've got FIFO accounting, effectively what that means is you account for the first thing you purchased, and that's treated as being sold first, both for COGS and for inventory. And that's important here. So when prices are falling, that means the prices of the things you bought first are higher than the prices of the things you bought last. So under FIFO, you would have had the expensive things sold first and then the cheaper things sold later. This basically means that FIFO is going to have a higher COGS and a lower inventory than would weighted average, because under weighted average, the price per unit is the same across the whole year here, because you're taking a weighted average of all of the units you've purchased. So here we'd be using weighted average instead of FIFO when prices have been falling. And we're being asked, what is the impact of this on total assets? Well, inventory is part of total assets. So what this means is our inventory will have increased. The reason it will have increased is, to reiterate, under FIFO, we would have sold the expensive things first, so those would have been removed from our inventory holdings, and that would have reduced our total assets. So therefore, this accounting policy is going to increase our total assets by increasing our inventory. Now, under number 3 here, you're being told here, what would happen if you expensed the expenditure instead of capitalizing development expenditure? Now, if you expense development expenditure, that means it's treated as an expense. Capitalizing it brings it into the assets. So the impact on net profit is it's going to go down, because here you'd be expensing it, which would decrease net profit. The next one you're asked about is what would be the impact of changing the doubtful debt policy from 5% of sales to 15% of sales, with sales remaining constant. Now, under doubtful debts, the way this basically is operationalized is you'll have debit bad debts expense, credit allowance for doubtful debts. So you're basically being asked here, what would be the impact of this on total assets? So here, when you've got these debts, basically the way it works is you have accounts receivable. The allowance for doubtful debts is effectively a contra asset to represent what proportion of those doubtful debts you are not going to recover. As a result, what do you have? Well, under total assets here, you're going to have, if you increase your allowance for doubtful debts, it would ultimately go down. The reason it would go down is you've now increased your contra asset, being that provision or allowance for doubtful debts. The next one, we're looking at total assets. And here what you have to do is looking at using the historical cost method instead of the revaluation method for buildings when prices have been increasing. So let's have a think about how this might work. When prices are increasing, that means obviously the market value of these things is going up. Now, under the historical cost method, you would not reflect this. You would still impair the relevant building when prices go down. However, you would not be adjusting it upwards as prices go up. By contrast, under the revaluation method, you would be revaluing it when prices go up. As a result, using the historical cost method is going to lead to a lower amount of total assets. So our total assets would decrease or be lower here. So let's write that one in as well, if we were to make that policy change. Now, under number 6, you're being asked what would be the impact of using the revaluation method instead of historical cost when prices have been increasing. Well, this is simply the converse. Using the revaluation method would increase your total assets. So it is absolutely the converse of what we initially saw just now. So as a result, we would increase our total assets in this context. The next one that you're being asked about is depreciating equipment over 10 years rather than over 5 years. Okay, so how would this affect things? So say the total amount of depreciation needs to remain the same. If you depreciate it over 10 years, that means your depreciation per year is lower than if you were to do it over 5 years. Under 5 years, you'd be shoving it into 5 years rather than 10 years. So think about it this way. If you've got $100,000 worth of total depreciation, if you do straight line for 10 years, that's 10K per year. If you do straight line for 5 years, that's 20K per year. So you can obviously see what the impact would be here. So as a result, our depreciation expense would ultimately change. So if we're doing 10 years rather than 5 years, it would increase our net profit because it would have decreased our depreciation expense. The next one we're asked about is what is the impact of changing the warranty provision estimates from 10% of COGS to 5% of COGS, with COGS remaining constant? Well, when you have warranties, the basic way this would work is you'd have a debit warranty expense, credit provision for warranty. So if you're moving your warranty amount from 10% of COGS to 5% of COGS, that's going to decrease your warranties here. If that's the case, you would ultimately decrease your liabilities and you would decrease your warranty expense. So therefore, what we'd end up with is a lower or decreased total liabilities. In number 9, you're being asked about the impact on net profit. And you're being asked about the impact from changing the revenue recognition from the percentage of completion method to the on completion method. So with the on completion method, you only recognize revenue at the very end of the project. With the percentage of completion method, you recognize it every single year throughout the life of the project, and overall, the net profit is going to be the same regardless of which method you use. However, the timing in which you recognize it is going to vary. So say you use the on completion method instead of percentage of completion method. That would ultimately decrease your profits in the present year. So with that in mind, we would decrease our net profit because on the on completion method, we simply recognize no net profit each year. Now in the final part here, you're being asked, what would be the impact of using FIFO instead of weighted average for inventory when prices have been increasing? Okay, so when prices are increasing, that means the first thing you bought is costing less than the last thing you bought. So under FIFO, you will have sold the cheap things and retained the expensive things in your inventory. So what that means is that under FIFO in that scenario, it will lead to lower COGS, but it will lead to higher inventory. So as a result, your total assets would be higher under FIFO here because you're retaining the expensive inventory in stock as compared to the weighted average method. So what we'd have here is under FIFO, our COGS in this case would be lower. The reason it would be lower is that under FIFO, we will have sold the cheap things first. i.e., if we're using FIFO, we're going to be selling off the cheap goods that we bought for a lower price, and that's because the prices of this inventory have been increasing over time. So that's how we'd go about answering what the impact of these policy changes would be on the firm's various accounts. We can then move on to the next question. Under the next question, you're being asked to evaluate a particular company. So basically what you're looking at is you're working for a company, and as part of this, that company is considering investing in Mod Limited, whose ratios you are given in the following table. And you're basically being asked about several questions about its financial health. And you have to evaluate to what extent, if at all, is its financial health reasonably healthy. So let's have a look at this. So what we currently have is you're being given various ratios, the current ratio, the quick ratio, et cetera, and you're being given some profitability type metrics. So ROE, ROA, and the like, and you're also given the industry average ROE. So the first thing you're asked is, are customers paying off their invoices slower in 2006 than they were in 2004? And you're being asked to support your answers. So let's have a look at what we might look at to determine this. So from the ratios that we have here, the only ratio that is directly relevant to this question is debtors turnover. The debtors turnover is effectively telling you, in brief, how long it's taking you to get the money back from your receivables, i.e. a shorter debtors turnover is going to be reflected in a higher number. So what that basically means is that as debtors turnover increases, you're recovering your debts quicker. So another way to think about this is in terms of days in debtors. So to get days in debtors, you take 365 and divide it through by debtors turnover. So at a 10 here, so for example, at 10.5 in 2004, it was taking roughly 36 days to recover the things, recover your receivables. By contrast, in 2006, your debtors turnover is 7. So it's probably taking you a bit over 40 days or thereabouts in order for you to get your things back from your receivables. What that tells you is it's taking you longer for you to be able to get your money back from your customers. So let's have a look at how we might reflect this in an answer. So we could perhaps say that it's slower. So we can say here it is taking more time to recover debts. And we can support this with reflection on the debtors turnover. And it is decreased from 10.5 to 7. This implies that people are paying off their invoices slower. So that's what we can do for part A. Now in part B, you're being asked to comment on the liquidity of Mod over the past 3 years. So by liquidity, that is effectively referring to the idea of how financially solvent is this company. And in particular, is the firm going to be able to meet its current liabilities? So there's a few things that we're going to be able to look at in order to assess this. So if we go back up to the ratios, several of these are particularly relevant. So the current ratio and the quick ratio are particularly relevant here. And in addition to this, we might want to look at inventory turnover. So with the current ratio, that's basically current assets over current liabilities. The quick ratio is non-inventory current assets over current liabilities. The difference is the numerator, i.e. under the current ratio, it's current assets. However, under the quick ratio, it is current assets minus current liabilities. What that means is the two can move in opposite directions. And if, like we have here, the current ratio is increasing from 1.8 to 3.0, that effectively tells us current assets are increasing as a proportion of current liabilities. However, the quick ratio has gone from 1.5 to 0.6. That tells us effectively the opposite, i.e. we're effectively seeing here that our current assets as a proportion of current liabilities when you exclude inventory is decreasing. So what might this tell us? Well, it might tell us that there's perhaps a buildup of inventory here, i.e. the firm has been amassing inventory, and that is not necessarily good for the firm, because the only reason these two differ is due to what is happening to inventory for the company, which tells us we're potentially facing issues for this firm, i.e. the firm is amassing inventory and this is a problem. You can also see how this manifests in the ultimate current ratio, or quick ratio, sorry, right here. So the 0.6. The 0.6 is initially a little bit troubling as well. It's a little bit troubling because it has gone below 1. What that means is that when you exclude inventory, the firm will not have enough current assets to pay off its current liabilities. Now we can also look at inventory turnover to get some more context for this. So inventory turnover has decreased from 8.8 to 6.5. That tells us that it is taking us longer for us to be able to sell our inventory here. That implies that the firm is potentially not being able to shift as much inventory, and this is manifesting in an inventory buildup, hence why current ratio might be increasing, whereas the quick ratio is not. So say we were to want to answer this question, we can formalize what our answer might look like here. So let me just type in what we might put here. So what we might say is the liquidity has worsened. And when we're saying the liquidity has worsened, we need to justify why this is the case. So we can say while the current ratio is increased, the quick ratio is not. This implies that the firm is potentially amassing inventory. Additionally, it is troubling that the quick ratio is below 1. This means that the firm might not be able to pay off all its current liabilities using non-inventory current assets. So that's what we've said so far. We can also add in the issue about inventory turnover. So it's also reflected in inventory turnover, which implies that we're shifting inventory lower. Further, the debtors turnover suggests we're collecting invoices slower as well. Okay, so that's what the liquidity position might look like. We can also look at reasons for why you might invest or not invest. So I'm just going to speak to this verbally because we've already talked through some of this. So the reasons to not invest can be the liquidity position is worsening, and in addition to this, it is taking us longer to be able to recover our invoices from our customers. A positive about this company is we can see that the ROA and ROE are in fact increasing. So if we have a look at this, both the ROA and the ROE have increased over the course of these years. They've also increased even though the industry average has decreased. This might imply the firm is reaching a degree of market dominance, and as a result, it might be a positive signal for this company. However, of course, we do need to bear in mind that a declining industry is still not necessarily a positive. So those are some reasons that we might have positives and negatives for this firm. We can then move on to the next question here. So the next question is you're effectively being asked about the impact of various transactions. And you're being asked about the impact of these for this company. The company in question has an ROA of 10% and a current ratio of 2 to 1. And what you're being asked here is what is the impact of various transactions on each of the ROA and the current ratio. Now, the actual levels of these ratios are going to be important, in particular the level of the current ratio, and you will see why in a second. So in our first transaction here, the firm has issued $300,000 of shares. So what is this going to do? Well, basically in net, what we'd ultimately have here is we'd have effectively a debit cash of 300K, credit share capital of 300K. Depending on how the issuance goes, There could be some other journal entries that might ultimately net out in between. Regardless, we'll increase our cash holdings and increase our share capital. Now, if you increase your cash holdings, you're going to reduce your ROA. The reason you would reduce ROA is think about what ROA is. It's effectively your net income, and you can define net income in various ways, or define the income level here rather in various ways. We'll sometimes see ROA expressed as net income to assets, sometimes EBIT to assets. Regardless, let's just leave net income for the moment. It's not really an operative consideration at the moment. It's net income over assets. So if your assets are increasing, your ROA is going to decrease. The current ratio is your current assets over your current liabilities. So in this case, we're increasing our cash. Cash is a current asset. So therefore, our current ratio would also have to increase. So both of these are going to increase. In the next one, we're being asked about what would happen if the firm purchased equipment for cash for $50,000. So if the firm were to purchase $50,000 worth of equipment, what happens? Well, we've transferred cash into equipment, i.e. we basically have debit equipment, credit cash. So our total assets remain unchanged. As a result, our ROA immediately is not going to have any change. So there will be no effect. For the current ratio, what would happen here? Well, we've lost 50K in cash. So our current ratio is going to go down. As a result, the current ratio decreases. There's been no change here in our liabilities. The next one is the firm makes credit sales of 80K on COGS of 60K. So if the firm makes these sales, its profit on these sales is $20,000. So the income portion of ROA will have increased. Furthermore, if the firm makes these sales, inventory has decreased. So assets have gone down. As a result, we know that ROA is going to go up. For the current ratio, what will have happened? Well, for the current ratio, we've cut down our inventory by 60K. Inventory is a current asset, so therefore inventory, a current asset, has decreased. However, offsetting this, we've got $80,000 in accounts receivable, which is a current asset as well. So the current ratio would also increase. So our current ratio and our ROA also go up. So in the next one, it says we've paid $10,000 to accounts payable. So here the firm has shifted 10K in cash to accounts payable, i.e. used cash to pay off debt. Now with ROA, we can see immediately what would happen. Here we've reduced our assets by $10,000. That is going to lead to ROA increasing. As a result, ROA would increase, and we can immediately see that. The question is what would happen to the current ratio? Well, with the current ratio, we can see several things here. So our current ratio is currently 2-to-1. So for example, it might be 200,000 divided by 100,000. So let's have a look at what this might look like. So the current ratio is currently going to be, say for the sake of argument, 200K over 100K. So that would give us 2-to-1. Now the new current ratio, is going to be, say we've paid off 10,000 in accounts payable. What would happen here? Well, we've lost 10,000 in cash. So now our numerator is going to be 190,000. However, we've reduced our accounts payable by 10K. So our denominator is now 90,000. So what that tells us is our current ratio will have actually increased. The reason it's increased is the percentage change in liabilities is greater than the percentage change in assets. So therefore, our current ratio will increase. Now, just think about this in another way. So we think about this purely algebraically. When you've got your algebra here, you effectively have x, and in this case, x over y for our current ratio. Now, what we've done here is we've taken off 10K from both. So we've got x minus 10, and then we've got y minus 10. Now, it turns out that x is in fact 2y. So when you look at it in this way, effectively you can see that you're going to have this increase when you've done the subtraction. It's going to go from 2 to something slightly above 2. Now, in the final one here, we've got the firm has received an electricity bill for $5,000. And this is for electricity used in the period. What that effectively means is the firm has incurred a $5,000 expense. Therefore, ROA will decrease. because the profit part of ROA will have gone down. Now, in terms of the current ratio, we can also see what might happen here as well. When the firm receives this bill, effectively here its current liabilities will have gone up. However, the current assets have not gone up. So by virtue of having the current liabilities go up, this is also going to decrease. Now note here that the electricity bill, say it were paid in cash. If the firm actually paid this off, then our current assets would have gone down and the current ratio would have decreased anyway. So regardless of whether the firm pays it or if it's left as a payable, you're going to get a reduction in your current ratio regardless. So that's how we'd go about answering this particular question. Then in our final question, you're being given a balance sheet for a company. Now in this balance sheet, you're given various items about, for example, the current assets, the current liabilities, etc., etc. Now I won't dwell on this right now, but it is going to be important for us to look at this in order for us to be able to answer the questions. So a question might come up. What are 3 examples of accounting policy choices that the firm might have made that might have increased this year's profit? And you have to support your answer using information from that case. So you need to look at these balance sheets and you need to be able to argue what accounting policy changes might have occurred that might have increased profits. So let's have a look at these balance sheets here. So if we scroll back up, there's a few things that are notable. And I'm going to focus on the things that are particularly important for profits that you see here. Now, in order for you to spot these, basically what you need to do is get familiar with financial statements and get familiar with the common things that can affect profits. So think about it this way. Common things that can affect profits include how you treat depreciation, what things you capitalize or not, how you're treating inventory, how you're treating provisions for bad debts and or warranties. Those are common things that can affect profitability. So let's have a look at if there's any evidence of those common things appearing in the balance sheets here. So I'm going to go with capitalization first. That's often the easiest one to spot. Of course, you can look at whether it was capitalized last year and is not capitalized this year. All right, so looking through the financial statements here, we can see one thing has been capitalized. So in particular, there's a capitalization of borrowing costs. In 2015 here, it was not capitalized, and in 2016, it was capitalized. This then begs the question of, maybe it was just the case the firm did not have borrowings in 2015, but has them in 2016. As a result, you get the capitalization in 2016, whereas you would have just had nothing in 2015. So to look at this, let's look at our borrowings. In particular, those borrowing costs are going to pertain to the loan. So here the loan was 600K and is now 580K. What that means is it's not obvious that there would have been a significant change in our borrowing costs. Those borrowing costs would be things in terms of, say, bank fees. It's not clear that those would have changed significantly. As a result, it appears the firm's treatment of borrowing costs will have changed profits. In particular, it appears the firm went from expensing it to capitalizing it. So that would be one thing that could be causing it. So that could be our first thing, the treatment of capitalization of the borrowing costs. So first, capitalization of borrowing costs. Now, I'm not going to belabor this by writing in the full context here. I'm just noting this as a placeholder. But obviously, for you to answer this fully, you would need to refer to the specific numbers and or refer to what has specifically happened, i.e. the fact that there's been, to answer this fully, no capitalization of borrowing costs in 2015. So, for example, no borrowing costs in 2015. So there's been basically borrowing costs capitalized in 2016, but not 2015, despite the fact that the debt has remained relatively similar. So that's our first one here. In our second one, what we might want to go for is what else might the firm have done that could have adjusted its profitability. And we can see what could have happened here. So let's have a look at an additional thing that could have affected profitability. So an additional thing that could have affected profitability is, say we're looking right here at how the firm is dealing with the allowance for doubtful debts. What you'll notice here is allowance for doubtful debts has remained constant. at 50K in each year. Now that would make sense if sales have remained roughly constant. However, our sales here have increased and they have not quite doubled. They went from 640K to 1 million. What that implies is allowance for doubtful debts are constant, but sales have increased. This suggests a change in how the firm is dealing with doubtful debts. Now, you might recall that the way you would account for doubtful debts is debit bad debts expense, credit allowance for doubtful debts. So if the firm has adjusted down the proportion of sales that it thinks are going to be doubtful, then, or doubtful debts rather, then that will increase profitability. So the second portion of our answer here could, for example, be 2, how the firm has dealt with allowance for doubtful debts. So in this case, allowance for doubtful debts appears to remain the same. So basically what we're saying here is bad debts expense has gone down, which will inflate profits. So let's hunt for another thing that could have happened here. So another thing that can happen is how you account for inventory. So let's look at how the firm is accounting for inventory here. So under inventory, the inventory has increased in this case from 600K to 1.34 million. So it has more than doubled. Now that would make sense if sales have more than doubled, but it appears that inventory is increasing more than double sales. Now that's weird, because that would imply one of two things have happened. Either A, for whatever reason, the firm has decided it needs to hold more inventory, or B, the firm has changed the accounting policies in relation to inventory. Now, we don't know which of these two it is. However, it is a possible reason the firm could have increased its inventory and then managed to reduce its COGS and therefore increase its profits. So let's have a think about how this might work. So say, for example, you're looking at FIFO, first in, first out inventory. The way that FIFO might increase your inventory holdings, say prices are increasing. If you shift from weighted average to FIFO, the effect that this will have is it will increase the value of your inventory, but it will decrease your COGS. That's because FIFO will be first in, first out. So if inventory prices are increasing, then under FIFO, you will have sold the cheap things first and kept the expensive things in inventory. That means your inventory will go up, but your COGS will go down. And by reducing COGS, you would increase the firm's apparent profitability. So let's go down and write in what that might look like. So our third option here would, for example, be we would have a change in how we're accounting for inventory. So in terms of changing for the account of inventory, we could have had a shift from weighted average to FIFO with prices increasing, which would increase inventory. And the support for this is that inventory has more than doubled, but sales have less than doubled. So that's how we might interpret several things that could influence the firm's profitability here, as done by the firm's accounting policy changes. In any case, I hope that gives you an idea about how you might go through answering various questions about financial statement analysis and what things could influence how the firm is accounting for various things and their impact on profitability and various balance sheet items. In any case, I very much hope the video has been useful, and thank you very much for listening in.